and welcome to Amber Data Derivatives. Today we'll be exploring the Lyra protocol in their recently launched version 2. Lyra recently launched its version 2 in Q4 of 2023. And unlike version 1, which was an AMM-based protocol, Lyra V2 is a gasless central limit order book system with on-chain settlement. The Lyra protocol has brought significant advancements to the DeFi options trading experience with their introduction of version 2, and we'll explore all of those advancements shortly. Although Lyra is an options-first DeFi protocol, Lyra also introduced a perps market and a spot market to go along with the central limit order book options trading experience. This allows traders to manage collateral and delta hedge their positions. Trading on the Lyra protocol occurs directly on their native app chain. The Lyra App Chain is an optimistic rollup L2 solution that's a container for all trading in the Lyra protocol. Users can onboard into the Lyra App Chain environment by bridging over funds such as USDC from Mainnet, Arbitrum, or Optimism directly into the Lyra App Chain environment. When a user wants to bridge over, say, USDC from Mainnet into the Lyra App Chain, what they're essentially doing is sending USDC into a Mainnet smart contract and locking their funds there, which then get recreated into the Lyra App Chain environment and allow free trade within the Lyra App Chain ecosystem. When a user wants to withdraw that USDC, they essentially destroy the Lyra App Chain USDC and then subsequently unlock the mainnet funds that were locked into the smart contract, essentially re-bridging out the USDC and allowing users free use between two chains. What's really nice about this architecture of having your own app chain for all your trading is twofold. One is that the transaction costs for executing trades or settling on chain become really cheap. The second really interesting thing about an app chain architecture is you no longer have outside competition in terms of transactions or different protocols competing for throughput on the blockchain. Essentially, you have your own dedicated environment to execute all Lyra trading on chain. The Lyra App Chain even has its own block explorer and allows users to explore what's going on in this ecosystem. Something that's important to note when trading on the Lyra V2 protocol is that although all the trades are paid for and settled in USDC, traders can actually fund their accounts with other tokens such as native Ethereum. When a trader deposits Ethereum into their trading account on the native app chain, Lyra essentially uses outside oracles to continuously value the value of their Ethereum or their collateral base. Additionally, Lyra applies a risk-based haircut on top of that collateral. So if Ethereum is currently trading $2,500, there will be a continuous valuation of that Ethereum price, plus a percentage-based haircut for additional risk compensation. This allows traders to essentially open positions using Ethereum as opposed to USDC in their account. When a trader in good standing wants to open a position using cross-collateral, or say Ethereum instead of USDC, when they buy an option, they'll pay for that option in USDC and essentially accrue a negative USDC balance in their account. The collateral is still in good standing because they have ETH in their account to offset the total risk, but the USDC balance is actually negative. An interest rate is then continuously applied onto that negative USDC balance. Interest is paid from negative USDC balance accounts to accounts with positive USDC. The interest rate itself is dynamic. It is actually a function of the utilization curve of negative USDC versus positive USDC in the ecosystem. At the limit, if the negative balances of USDC almost matches the positive balances of USDC, the interest rate is going to be so high that the incentive to close out negative USDC balances is going to be really, really strong. This ability to have negative USDC balances and positive USDC balances is the reason why Lyra also launched the spot market. This allows for easy collateral management for people using cross collateral. If you have ETH in your account and a negative USDC balance, you can use the Lyra spot market to sell the ETH for USDC and then flatten up your negative USDC balance. In my opinion, the most impressive accomplishment of the V2 protocol introduced by the Lyra team is the launch of both standard margin and portfolio margin types. After a trader funds their initial account, that same trader can then launch sub-accounts and designate the various types of margins per account. A trader can have a ETH portfolio margin account and a Bitcoin portfolio margin account, and then another standard margin account, enjoying the trade-offs between the different margin types. The standard margin account is a rule-based margin requirement system with two distinct advantages. First is when using a standard margin account, a trader can open both Bitcoin option positions and perpetuals, as well as Ethereum option and perpetual positions, mixing both coins against each other. The second really impressive feature of the standard margin account is that defined risk strategies or finite risk strategies such as verticals and butterflies have a margin requirement that's capped to the maximum loss. This means a trader can trade a four-legged spread such as a butterfly and only pay the cost, or short a vertical, say a call vertical, and only pay the maximum loss in terms of margin requirement. Combine this with the Lyra RFQ system, and now traders can execute large packages at efficient pricing with efficient margining. This allows for really big positions to go through the Lyra system and be settled on the Lyra App Chain. Unlike standard margin, portfolio margin is not a rules-based margin requirement system. It's actually a scenario-based margin requirement system. This allows traders to open positions across the time space and the strike space combined with perpetuals in order to have a margin view that's holistic on the portfolio itself, calculating margin requirements based on various scenarios. Some of these scenarios are based on price shocks on the underlying currency, as well as fall shocks up or down, and calculate the actual theoretical P&L loss or gain from different scenarios to ensure that the holistic portfolio is in good maintenance margin standing. One important caveat about portfolio margin within the Lyra ecosystem is that each sub-account has to be dedicated to exactly one type of currency. A sub-account could be a Bitcoin portfolio margin sub-account, while another sub-account can be an Ethereum margin sub-account. And the reason why that is because the scenario-based portfolio margin system has to look at the scenarios for a specific individual currency and can't mix both Ethereum and Bitcoin scenarios. However, traders can open multiple sub-accounts and trade an ETH portfolio margin sub-account here and say a Bitcoin portfolio margin sub-account there. The secret to a good derivatives trading exchange is the ability to provide leverage. But in order to provide leverage, the protocol needs a really good, dependable risk engine, as well as a fair and reliable liquidations process. This means that anyone who's in violation of margin requirements is not an existential risk to the ecosystem itself. Options markets are especially tricky for this task because options have so many instruments and typically have less liquidity than Delta One products. In fast markets or volatile markets, traders and market makers often widen their quotes or pull their quotes off altogether from the book. This means that having a midpoint between bid and ask is no longer possible, and valuing options in this type of environment is extremely difficult. This means that the protocol itself needs to continuously calculate fair theoretical values for each and every options instrument, no matter what the liquidity situation is at any point. These theoretical values, or marks, are continuously calculated and are provided to the system and the smart contracts in order to check for violations of margin requirements. Lyra achieves these theoretical values, or these marks, by using third-party providers to continuously stream in spot prices, forward prices, and a fitted volatility surface. These marks are then determined to be the fair valuation point for each and every options instruments and allow for fair, dependable valuation of a trader's account and whether it's in good standing. The beautiful thing about the Lyra risk engine and maintenance margin violation is that these violation checks are computed directly on-chain via smart contract. So if a trader is liquidated, there's actually an auditable trail showing why this trader got liquidated and the scenario that caused the liquidation out of the maintenance margin requirement. Anyone in the world can monitor a trader's sub-account for any maintenance margin violations. And if there is a maintenance margin violation, they can trigger a keeper bot to start the liquidations process. In terms of standard margin, the smart contract will check to see if the account is in margin good standing or not, and if not, then start the liquidation process. But if it is in good standing, we'll reject the liquidation process, while portfolio margin accounts require a keeper bot to start the liquidation process by providing a portfolio margin scenario violation along with it to save on computation costs. When an account is actually in maintenance margin violation, the Lyra system will actually start an intelligent piecemeal liquidation process. The V2 protocol will take the trader's portfolio as a whole and sell off little slices pro rata of the entire portfolio until the account is in good standing. Instead of just paying through the market to close out positions, the Lyra V2 protocol will take a slice of the portfolio and start a reverse Dutch auction process, allowing anyone to bid on that part of the portfolio and buy it at a discount. If no one is bidding on the portfolio or the liquidated portion of the portfolio, the price continuously drops and drops and drops, creating a larger and larger haircut to the fair market value, allowing a bigger and bigger profit potential for the bidder of that liquidation. Again, the most interesting aspect about this liquidation process, in my eyes at least, is that all of this is auditable directly on-chain because liquidations and margin checks are computed directly on-chain. This allows for traders to have a self-custody trading experience without creating externalities to other traders in the ecosystem. Finally, the last part of a trade's life cycle is the settlement process. Lyra options are European cash settle options. This means that the final intrinsic value of an option is paid out in USDC. Options expire at 8 a.m. UTC, at least of this recording, and settle to a 30-minute TWAP of the underlying spot price. This is how we determine intrinsic value for all options at expiration, and USDC funds get shifted between debtors and creditors at the end of the expiration settlement process. Thank you for joining us, and I hope you found this Amber Data Derivatives tutorial insightful.